Although our next guest says gold is likely to climb to 1,400, he thinks the Brexit concerns may be a little overdone. Joining us is Julian Jessop, head of commodities research for Capital Economics. Thanks for joining us on the line from London, Julian.
You're welcome.
So your research firm was among those calling for 1,400 gold if the UK were to leave the EU. In fact, this happened. Are you sticking with this number now?
Well, first of all, we've always had a forecast of $1,400 for gold. The question is when it was going to be reached. Originally, our forecast was that level would be hit at the end of next year. But we've been stressing instead that if the UK does vote for Brexit and market uncertainty continues, then we could hit that target as soon as at some point in the next few weeks. That said, global financial markets do seem to have been calming down after the initial negative reaction, as we thought they would. Indeed, the UK equity market, the main index, the FTSE 100, has just recouped all of its losses since the Brexit vote. So maybe 1,400 is a bit of a stretch over the next few days or weeks, but I still think we'll be heading there over the next year or so.
Okay, so if we do head there, are you saying it could possibly be a knee-jerk reaction and then gold prices would come back down?
Well, to be clear, a lot depends not so much what happens in the UK itself, but how the rest of the world responds.
Right.
The UK itself is only 4% of global GDP, and much as I'm a Brit myself, I don't want to overplay its global importance. But if turmoil in the UK spreads to the rest of Europe, and in particular as a result of that, central banks globally loosen monetary policy, or at least keep interest rates lower for longer, particularly the Fed, then that, I think, is the scenario in which gold does the best. As it happens, I think that the case for the Fed delaying rate hikes for much longer on the back of Brexit fears isn't actually that strong, particularly with equity markets now rebounding. But it does reinforce the point that rate rises in the US will remain gradual, and US interest rates are still going to be at a fairly low level in a year or so's time, even if they're higher than they are now. And I think that has to be a favourable backdrop for gold, given that inflation pressures in the US are picking up, and that demand from emerging markets, whether that's household or central banks, is likely to remain strong.
Julian, your firm's founder, Roger Boodle, was very vocal prior to the vote on how the Brexit doomsday scenarios were a little overblown. Do you think the markets are overreacting here?
Well, I think they were. I mean, part of it is simply the uncertainty that nobody knew quite what was going to happen in the event of a vote to leave. Even those people arguing that the UK would or should leave didn't seem to have much of a plan of what would happen next. So it's understandable that you have a lot of uncertainty and the markets don't like that. But I think that's been overtaken by a couple of things. The first is the recognition that nothing actually happens straight away. So the UK is going to remain a member of the European Union for several more years. That leaves some time for negotiators to ease some of the uncertainties about the UK's place in the world, and particularly about its trade relationships with the rest of the European Union. So the first point is nothing really happens straight away. The second point is that one thing that has changed is the official rhetoric. So ahead of the poll, those policymakers who wanted the UK to remain in the EU, which was frankly most of them, had an obvious incentive to talk up the risks, to make people worried in order to influence the electorate. But now that so-called campaign of Project Fear hasn't worked, the emphasis has changed. So policymakers are trying to reassure investors and businesses and households more generally that things are actually going to be okay. So we've had more positive noises from central banks in particular that things are going to be okay, that even policymakers like the Chancellor of the UK, our Treasury Minister, has been saying that things are actually going to be all right, and the UK economy is strong enough to weather this. So the tone of the rhetoric has changed. I think that's helping the markets.
All right, Julian, with the time we have left, there's some quick thoughts on silver, which hit $18.50 today. The metal is now outperforming gold. What's at play here?
Well, I think it should outperform gold. I mean, first of all, of course, when gold itself is doing well, for whatever reason, silver tends to outperform. It's effectively a more volatile version of gold. But also, silver should benefit more from industrial demand. So if the fears about the global economy collapsing in the wake of Brexit prove to be wrong, as I think they will, then gold should rise, but silver will do better still because of the industrial component of its demand.
All right, Julian, thank you so much. Thanks for joining us.
You're very welcome.
And stay tuned. We're talking with the World Gold Council up next.